got a trade here on Panera. We do not like it. We think you should sell it short, get out of it if you're long. But let's look at a few of the things that perhaps give us a setup. This, of course, is a one-year chart of unleaded gasoline, and we know that there's seasonality, but the important thing is we're back to the June highs of exactly a year ago. So you could say, okay, so big deal. But here's really a longer-term picture. Despite of course, the collapse associated with the bear market and the financial crisis, we've been persistently high here, staying at or near all-time highs, and ultimately we think this has the possibility of breaking out and exceeding the peak from the prior cycle high. Not good as a setup for consumer, restaurants, and other things. Now take a look at a few other things that are relevant to this. This is the CRB foodstuff index. It's got lard, hogs, cattle, wheat, soybean oil. This is up substantially over the last 6 to 8 months. We're talking about a 40% increase. Take a look at a couple other things. Here's chicken prices. You're talking about from the '07 low, unabated, and people say there's no inflation. It's just not true. Take a look at cattle prices from the '07 low. Basically unabated. There is inflation. Look at Panera. Now, we know the stock market's gangbusters. This is not a gangbusters chart. In fact, it's a 2-year chart, and the real risk here is that this stock is toying ominously with the prospects of breaking well-defined lows and coming out through the bottom. To put this current setup in perspective, take a look at this long-term chart. We know it's been on trend. We know it's been a great winter. And look at what has just happened. We have officially broken trend. Not good. Panera can be drawn this way if you'd like. A huge rounding top. Here there's the break point. Any way you cut this thing, or you could just draw the trend line and leave it in there. This is not a good setup. If you're long Panera, you should be concerned. If you're looking for a short, we think this is a good one.
So walk us through your bearish trade.
Very simply, all I'm looking at doing is buying the January 145 put, paying 9.25 for that. So that's the first out-of-the-money strike. Out to January, those options are not decaying very rapidly. Because there is a short interest, this is one of the reasons you would not want to short the stock yourself, because short interest sets up for a short squeeze. I'm not saying that's what's going to happen here, but if those people decide to start covering, that's a risk if you're short yourself. So I think this is a good way to make a play, and you could always look for opportunities to spread.